There's a lot of hype around restaking, liquid restaking points and airdrops related to these systems. But just be aware that the core of all of this, there will be something built on top of EigenLayer, which can generate this yield, this restaking yield that people are betting on, that people are deploying literally billions of dollars in order to get down the line. You need something real underneath all of these incentives. All right, welcome to Crypto with Cami, where we go through all the main headlines in crypto and DeFi in the past week in 30 minutes or less. This is the show for the week starting February 5th. The biggest trend this week was in Ethereum restaking, with EigenLayer lifting the cap on its liquid staking token pools. We also covered moves in the real-world asset sector. There's a hot new token standard in town, the ERC-404. There were a few new token launches, airdrops, and announcements. The Solana blockchain went down for a few hours at the start of the week. So there was a lot going on. But yeah, let's start with the biggest news, restaking and EigenLayer. And I'll give you my hot take after the main headline. EigenLayer is one of the biggest developments in crypto in the past couple of months. It introduced an entirely new primitive with restaking, and it's now become the 5th largest DeFi protocol by TVL, unseating Uniswap. This week, it became even bigger by removing the caps on its liquid staking token pools for the first time on February 5th. The window for uncapped pools closes today, February 9th at 8 p.m. Eastern. So with the limits off, EigenLayer's TVL more than doubled to almost 6 billion from 2.2 billion at the start of the week. Data from Dune Analytics shows that EigenLayer currently holds over 10% of all LST supply. So EigenLayer supports 12 LSTs. Lido staked ETH accounts for more than half of EigenLayer's liquid staking TVL, followed by Swell's SW ETH at 12%, Mantle's M ETH with 10%, and Stater's ETH X with 5.6%. So what this means is that anyone can deposit their liquid staking tokens on EigenLayer to start earning Ethereum staking yields plus EigenLayer staking yields plus all the other, airdrops and points that are being layered on top to incentivize these protocols. So we've just seen explosive growth of EigenLayer since it launched. And let's backtrack a little bit to understand what restaking is all about. First, let's establish this is all happening on Ethereum, which of course is now a proof of stake network. It transitioned from proof of work. That means nodes or validators are required to make deposits in ETH, Ethereum's native currency, or to stake ETH to secure the network. So far, so good. Now, the responsibilities of running your own node and the requirement of staking 32 ETH or multiples of 32 ETH isn't for everyone. So there are middleware services which allow users to stake any amount of ETH and delegate the operations of running a node and being a validator. These services also issue tokenized representations of users' staked ETH. And these are called liquid staking tokens, or LSTs. Lido and Rocket Pool are the largest liquid staking providers. There is now 32 billion in liquid staking tokens, and they represent about half of all ETH staked. Okay, now we know staking, we know liquid staking. Now the next step is restaking, and here's where EigenLayer comes in. So EigenLayer is the first protocol which allows stakers in the Ethereum network to use their staked ETH to secure other protocols, not just Ethereum. That's why the process EigenLayer enables is called to restake or to stake again. It works in two ways. Users can either restake natively or stake via a liquid staking token. So when you stake natively, you're staking ETH directly on Ethereum and then redirecting your withdrawal credentials to EigenLayer. Or you can deposit liquid staking tokens on EigenLayer. And this is what it looks like, basically. So here we're on the EigenLayer app, and you can deposit, you can create an EigenPod where you redirect your credentials and deposit Beacon Chain ETH or staked ETH. Or you can use all of these liquid staking tokens to deposit to EigenLayer. So the idea here is that stakers can now get Ethereum staking yield, and on top of that, staking yield from other protocols that are using EigenLayer to subcontract Ethereum's base layer security. So we know now staking, liquid staking, and restaking. The next step is liquid restaking. So now that we have this new primitive with EigenLayer, where users can restake or reuse their staked ETH on other protocols, there are new middleware protocols that become the interface for EigenLayer, allowing users to deposit ETH and liquid staking tokens to liquid restaking protocols. These are EtherFi, Puffer Finance, KelpDAO, Renzo, and others. So these protocols take these deposits of ETH or LSTs and deploy them on EigenLayer. In exchange, they give users a representation of their restaked ETH in a liquid restaking token. The idea is that now the trader earns Ethereum staking rewards, EigenLayer restaking rewards, and on top of that, they have a liquid token that they can use elsewhere in DeFi to continue generating more money on top of that. So there is about 2.7 billion in liquid restaking protocols, according to DeFi Llama. So we see how the sector was basically inexistent as of just last year. And now it's skyrocketed to over 2 billion. EtherFi is the largest protocol, followed by Puffer, Kelp, Renzo, EigenPi, and so on. So really a booming sector in the liquid, staking, restaking, liquid versions of it all. Now let's go quickly to the fundamentals. The goal of EigenLayer is to make staking more efficient. They are using staked ETH to secure more than just Ethereum. So EigenLayer lets builders focus on their specific dApps or protocols without needing to create their own validator sets, set up complex consensus mechanisms, or launch their native tokens if they don't want to. To understand what actually happens when you deposit on EigenLayer, there are two key terms you need to know: operators and actively validated services, or AVS. AVSs are the dApps and protocols that use EigenLayer to bootstrap their own security. They can range from simple apps or services to complicated protocols that look kind of like independent L1s. Now, operators run software on behalf of these AVSs. Their role is pretty similar to a role of a validator on Ethereum. So you have EigenLayer operators running software and securing stake for AVSs, and AVSs are these dApps and protocols building on top of EigenLayer. So when you restake on EigenLayer, you're delegating your ETH to these operators. And these operators will choose to secure different AVSs building on EigenLayer. And each AVS will have its own separate security and slashing rules. So this obviously introduces new risk for stakers. Have the risk of getting slashed on Ethereum, plus the risk of getting slashed on the AVS you're securing. Slashing happens when validators or operators misbehave. So just be sure that you know the risk that you're taking. Here's the key. The key for this all to work, in my opinion, is in AVS. It's where the extra staking yield comes from. They need to generate enough fees to pass on to operators and restakers. That means there needs to be enough economic activity happening on top of these dApps and protocols. So what are these AVSs? Let's take a look. EigenLayer's website lists them. Let's see. I have them here. Okay. So here's what EigenLayer website shows their whole ecosystem. You can go through who their operators are and also what the AVSs are. So there's between 15 and 16 AVSs. And you can see here, so EigenLayer has its own AVS, EigenDA. It's the first AVS on EigenLayer. It empowers rollups with cost-efficient, hyperscale throughput and data availability. So that's one AVS. It's built by EigenLayer itself. Then you have others, Ethos, AltLayer. AltLayer is the only AVS so far with a token. Blockless, Drosera Network, Espresso, Ethos. And you look at the descriptions of all these, and they're pretty kind of arcane or like complicated sort of infrastructure for blockchains. They're not dApps that any kind of end user would usually interact with. So Ethos is a modular and decentralized policy engine tailored for compliance. AltLayer is a decentralized interlayer for rollups using EigenLayer for fast finality. Blockless, verifiable computing engine, economically incentivized via restaking. Espresso, decentralized sequencing using restaking for Ethereum. Hyperlane, using EigenLayer to enable interchain app developers to secure messaging using restake economic security, etc. So, and these are all pretty early stage dApps, chains, and protocols. They have no, at this point, significant adoption or users. So there are many risks to EigenLayer, but to me, this is the core premise they need to fulfill in order for the system to work. Their proposition needs to be strong enough for valuable teams to decide to bootstrap their security via EigenLayer. Whether this will happen is still TBD, in my opinion. For now, yield for restakers is coming from points and potential airdrops that the different layers in the system are deploying. Everyone from restaking protocols to AVSs. I don't know if operators are deploying points, but EigenLayer itself is deploying points. This is where the yield is currently coming from. These points, which down the line are expected to become airdrops. Now, what happens when all of those incentives run out? Something real needs to remain under all of these, token airdrops. And maybe, it's what's getting built out. There's no doubt that EigenLayer's innovation is huge. The promise makes a lot of sense. It makes sense to make stake more efficient and to use Ethereum's security for other chains and protocols and dApps built on Ethereum. But it's also true that you're introducing new layers of risk and you're making assumptions about adoption of this entirely new system that hasn't been proven out yet. So, there's a lot of hype around restaking, liquid restaking points and airdrops related to these systems. But just be aware that the core of all of this is that there will be dApps, chains, there will be something built on top of EigenLayer which can generate this yield, this restaking yield that people are betting on, that people are deploying literally billions of dollars in order to get down the line. I know that they're actually deploying this to get these points. But again, these will run out at some point. And then what do we have? You need something real underneath all of these incentives. So that's my take. Let's get on to other headlines. So, more SEC being bad for DeFi. Surprise, surprise. So the SEC expands its definition for securities dealer to include DeFi market makers, or better known as LPs, liquidity providers. So February 6th, the SEC passed 2 new rules expanding the definition of a financial securities dealer, with 3 votes in favor, 2 votes against. The new rules expand the definition of regular business activities to classify all liquidity providers commanding at least $50 million worth of assets. And those are deemed to comprise securities as dealers, including entities operating on DEXs. So the SEC now defines a digital assets dealer as a person engaged in a regular pattern of buying and selling crypto asset securities that has the effect of providing liquidity to other market participants. Liquidity providers trading less than $50 million in assets are exempt from the rule. The new guidelines will take effect 60 days after being published to the Federal Registrar, with market participants required to comply with the rule 1 year after that date. It will likely be April 2025. So, the changes were opposed by Hester Pierce and Mark Ulleda, but found support from commissioners, obviously Gary Gensler, and other too. What's controversial about this is that, what they're saying is liquidity providers have to register a securities dealer for dealing in over 50 million of crypto. But so far, the SEC has yet to actually define what constitutes a security in crypto. So, they're setting all these rules for LPs indexes without, resolving the underlying issue, which, of course, the industry has been asking for clarity for years and years now. But, it still remains in a gray area what actually constitutes a security in crypto. Next, in the real world asset front, super interesting, Mountain Protocol is a new contender in the field that has very quickly climbed the ranks. So just 4 months after its September launch, Mountain Protocol stablecoin, USDM, has become the second largest asset in the US Treasury-backed sector, and the largest Treasury-backed stablecoin, according to RWA.XYZ. So in this chart, you see Franklin Templeton's on-chain Treasury fund, and then second to that is Mountain Protocol's USDM. And this growth also made Mountain Protocol the third largest RWA protocol by TVL after Maker and Ondo Finance. So definitely something to watch. USDMs, this, Mountain Protocol's stablecoin, the key feature is that it currently returns 5% APY to holders from passing on yield of US Treasuries. Also in RWA, Ondo Finance is now offering its stablecoin on the SUI network. Ondo stablecoin, like Mountain Protocol stablecoin, also passes on treasury yield to holders. And next up is the hot new token standard ERC-404. Super interesting. So this token combines the liquid tradable nature of ERC-20s and the non-fungible aspect of ERC-721s. So the first token, or one of the first tokens to use this standard, is Pandora, which spiked to over $100 million in market cap since its February 2 launch. The way this new token standard works is super interesting. So Pandora issued 10,000 ERC-20 tokens along with 10,000 replicant NFTs. If a user buys one full Pandora token, one replicant NFTs is automatically minted to their wallet. Conversely, if that user sells their Pandora token, the linked NFT is burned. So, when you buy these ERC-404 tokens, you get two tokens, a tradable liquid ERC-20-like token and NFT. So definitely a new development to watch. Another hyped up launch was Morpheus AI. This new dApp and its token attracted over $50 million less than a day after launching. Eric Voorhees is involved in the project, and Morpheus aims to make Web3 more accessible by providing neutral ChatGPT-like chat interfaces, enabling users to easily buy, sell, trade, do different operations in DeFi via a chat-like interface. So to incentivize the network, Morpheus is launching its MOR token, and traders can deposit staked ETH to get MOR emissions. So yeah, this had tons of interest on the launch. More token launches and announcements. We have Wormhole, the popular cross-chain bridge, unveiled its tokenomics and upcoming airdrop. The W token will have a total supply of 10 billion tokens, of which 11% will be airdropped to the community. The snapshot was already taken, and a date for the airdrop wasn't disclosed. Next up is Pyth Network, which announced the second phase of its airdrop. Pyth Network is an Oracle provider. It said its Pyth tokens will be distributed to over 160 DeFi applications that use its data. The project will distribute 100 million Pyth, worth nearly $50 million at the time of writing, to Web3 applications across a broad range of use cases. Next was Dymension. Dymension also launched mainnet with a $300 million airdrop. Dymension is a Cosmos-based modular blockchain and launched its mainnet with its DYM token. So eligible claimants can now access their tokens by connecting their wallets to the network. Dim started trading at around $4, and that gives the project a fully diluted valuation of $4 billion. The team allocated 70 million DIM, or about 7% of the supply, to the airdrop. Okay, I'll run through the last few headlines. Frax launched a modular layer 2 blockchain. Fraxtal leverages the Optimism stack and will airdrop FTXL points to VEFXS stakers. Following the Farcaster frenzy, now obviously there are tokens involved. There are different community-based tokens being launched on Base, the Coinbase Layer 2. Degen was one of the most popular ones, surging over 150 million in market cap. It seems like the meme coin frenzy in Solana has now moved over to Base thanks to Farcaster. Another Solana linked news is that the Solana blockchain had an outage of 5 hours early this week. Solana had almost gone a year without an outage, but this broke its streak. Of course, as you guys probably know, Solana was famous for having, degraded operations, degraded performance, I should say, and outages. It's been plagued with these issues, and so we had this outage once more. Sold price lid. I think it's pretty concerning, to be honest, that a huge layer one is still having these issues. So hopefully they're able to solve it, and we get a more stable blockchain, because they've made so much progress this in the past few months. Next up, we have a couple of big name announcements. Metamask adds Robinhood integration. US users will be able to fund their non-custodial wallets through Robinhood Connect. And this is a big one as well. Ethereum name service announced a partnership with GoDaddy, one of the biggest DNS providers. So what happens with this is that GoDaddy's domain name holders can now easily link their addresses to ENS names without requiring technical expertise or additional fees. And finally, we have a date for Ethereum's Dencun update, which is March 13th. Dencun will reduce layer 2 transaction fees. So that's all for this week. I hope you enjoyed this update. Let me know your thoughts on liquid restaking, liquid staking, and EigenLayer. I also want to do a quick shout out to Dgate, our sponsor. Check them out. They're having an exclusive airdrop for Defiant readers. You need to qualify as an active DeFi trader, and from then on, you can get Dgate tokens. So check it out. It's in our website. Look for Dgate exclusive airdrop event. Definitely worth participating if you're an active DeFi trader. So thank you so much for watching, and see you next week.